I also want to remind you, ngfn.org/hubfinances. We link to a ton of excellent Food Hub financial resources there. Not only are all of the recorded sessions of the series linked to, but some other excellent researches, such as the Food Hub benchmarking study and the associated webinars there, and the common charter accounts that we were really exploring in detail in this series. I'm going to hide this slide in a second because Aaron and Gary are right there. Oh, maybe I'll keep it up. Aaron and Gary are there on the video. And so raise your hand with your questions, type in your questions, and we will dig in. The first questions, though, I want to address are the questions, a couple of the excellent questions that were asked during the last webinar we didn't have time to address. So Aaron, Gary, if we can start, can you review the difference between cash and accrual accounting and maybe why one would choose one or the other? Oh, and we do have slides up here. Here, let me...
Sure, if you want to go to the example at the end. Gary, you want to start, and then I'll jump in with the number part?
Sure, just real quickly, cash accounting is kind of like your checkbook. It's where you record sales when you get the money, when somebody gives you a check, and you record an expense when you actually write a check or pay the money out. An accrual is what you should be aiming for, which is where you would report income on your profit and loss when you generate it. In other words, not when you get the check, but when you say, I have sold this thing, it becomes income. And then expenses, likewise, are shown on your profit and loss when they are incurred. So you haven't necessarily written the check, but you have ordered and received those supplies.
Right. And most small businesses, Hubs included, can operate on the cash basis for tax returns, which means you pay your taxes on a cash basis. That's fine. Just keep in mind you do that once a year, and you're going to be managing your Hub every day. So if you can manage on the accrual basis and know what's really going on, you're going to be that much farther ahead from a management perspective. So Jeff, for the review, have put up this slide, which gives the example. There are 6 items that you want to be concentrating on the balance sheet. And we've got 3 of them highlighted that we used for our example on the Tuesday session. So the first one is accounts receivable. Right below that, we see inventory. Below that is supplies. Then the prepaid expenses are highlighted in gray. And those are the 4 things that you want to look at on the asset side that will have an impact on your accrual earnings. The changes in those have an impact on your accrual earnings. And then on the liability side, it's the accounts payable, and then right below it, the accrued expenses. And the reason an operating loan doesn't is because the operating loan is just switching the timing of when you pay expenses. It's not taking care of them in and of itself. So for instance, if I'm growing vegetables, I'm paying for things early on, and then I'm getting paid later in the year. The operating loan allows me to actually pay for those things, and then I pay down the line when I get paid. So that's why that one's not included. The 7th thing, the bonus that we need to think about that has a difference between cash and accrual, is depreciation. And that's what makes tax reporting sort of a hybrid method, because you don't actually pay cash for depreciation, yet you're allowed to write off a part of your purchase of equipment, buildings, etc. over time. And the goal there is to sort of shield that income from taxes so that you could be saving it towards a future replacement purchase. So think about buying a truck, costs $50,000. If you depreciate it over 5 years, because that's the IRS rule, if you harbor $10,000 a year in depreciation without having to pay taxes on it, theoretically, right? Think about putting that into a savings account, and at the end of 5 years, when you need to replace that truck, you'd have $50,000 and be almost to where you need to be to replace it. So I don't know anyone that actually operates like that, but it would be a pretty fantastic savings tool if you could. So just something to think about. All right, so let's go through this example. Accounts receivable, that's the one highlighted in orange. 2016 year-end balance sheet is on the left column and 2015 is on the right. So if we look at the change in those two, going from $8,000 to $65,000 in accounts receivable means we sold a bunch more stuff that we didn't get paid for. So Jeff, if you can advance the slide, I think it's probably 2 clicks right now, will show us accounts receivable. Because they went up, we're going to add $57,000 to our income, right? And from the accrual perspective, because we really did earn that, even though we haven't been paid for it yet. The next example we went through was the prepaid expenses, where at the end of 2015, we had this sitting in our bank of prepaid of about $16,000, and then it went down to $5,000 at the end of the year. So that means we used up $11,000 of prepaid expenses. We don't have them anymore because we actually incurred them. So we need to make sure that we capture those $11,000 as part of our true expenses for the year, even though we'd paid for them at some previous date. So we're not going to see a check written in this year, but we really did use those expenses in that time period. And then the third one we went through by way of example was the accounts payable, highlighted in yellow. At the end of 2015, we had a balance of $8,000 that we owed someone. And then at the end of 2016, we owed $15,000. So that difference is $7,000 of product or some other bill. We need to go dig into the notes and find out what it's for, that we really incurred in this year. So we need to add those $7,000 to expenses. And then when we go look in the detail, we know exactly what expense we need to look at increasing from the accrual perspective so that we have true management numbers. All right. And then you would do the same with inventory and supplies along the way. But those were a couple of the ones that we took for an example.
Good. All right. Again, type in your questions, raise your hands. I'm going to go move on to the next question asked from the presentation webinar. What is the difference between net margin, contribution margin, operating profit, and net earnings? Net margin, contribution margin, net operating profit, and net earnings.
Okay, always good to define the audience with whatever audience you're looking at. So net margin is another word for profit in most circles, which would be the same thing as net earnings, right? Because at the end of the day, that's everything that you've brought in minus everything that comes out. Contribution margin may be what we've referred to as gross margin, because I've often heard it referred to as contribution to overhead and profit. So those are a couple of different words that get exchanged. And then operating profit, that's one of those that you want to look at in the context of what study or what situation you're working in, because operating profit may be from operations, meaning before you get to your general and administrative, aka your overhead costs. But I've also seen some people refer to it as from operations, which is another way of saying net profit. So it's a great question, and you want to make sure that you can define them in the context in which you're working.
Okay. All right. This is a good one. In operating a direct-to-consumer hub, one of our biggest costs is delivery. Some of that cost feels variable, like hours paid to delivery drivers, and some of that cost feels fixed, like truck maintenance. Are some cost categories both variable and fixed?
Oh, great question. So if you went to Cornell, right, Gary, we've had plenty of folks that beat us with those acronyms from back in the day. We talked about the Dirty Five in previous places to look at your overhead. But the other acronym was roles, that you may have some fixed costs that that seem variable depending on what you're doing because they're part of your production. And I think the roles were something like repairs, oils, lubes, lights, and supplies. So you have to take a look at what it is for your individual business. And I think you're absolutely right. truck maintenance is a fixed expense in terms of I need to repair that transmission, whether I go drive it one more delivery route or I do it for another 100 delivery routes. But certainly hours to deliver as a labor expense is definitely a variable cost. So I think you're on the right track there. What you might also do, and I've seen some hubs do it or other businesses as a case study, year-end analysis, let's pull out all of the costs related to delivery and figure out what is that on a per order basis or, a per day basis or whatever other common denominator you want to use. And then that's a really good real world checkpoint of, does it make sense to maintain our own fleet, or is this something that we might want to consider another way to do it? Because we only have a limited amount of resources, whether that's time, effort, energy, money, you name it. If we can figure out how to be as efficient as possible with it, then there's more money available for the rest of our mission.
I think the main thing is to be consistent, whatever you choose to do. If you're calling truck repairs fixed expenses, make sure you always put in something for repair into that fixed. And really, it's sort of the purpose of the webinars is to help decide a strategy for you and how to treat these expenses. And it's not like we're deciding; we're encouraging you to decide how you're going to treat these categories. We're suggesting what would be typical and what would be helpful as far as having your chart of accounts conform with what the benchmarks will show, so that you can actually use the benchmarks in a better way. So it's something to figure out with your accountant or your bookkeeping system to be able to be consistent.
There are a couple of questions about really focused on managing from the income statement. One question is, how often should I refer to my income statement?
Oh, great question. So I think there are a couple of questions that you want to ask yourself. One, am I in the busy season? Are all of my accounts receivable coming in within 30 days? Are all of my accounts payable being paid within 30 days? A couple of those parameter questions, and if you can say yes, then you can probably look at it once a month. But if you're in your busiest season, right, then you probably need to be looking at things every week. For instance, some of the corn mazes I work with, they're open for 6 to 8 weeks in the fall. So if something goes wrong, they want to know about it as soon as possible so they still have time to adjust. But if you look at it once a month, that starts September, you look at it October 1st, half of the season's gone, and you've potentially missed out on an opportunity. The other beautiful thing about working with a chart of accounts such as this is you can distill it down and look at that 5-line or 6 or 7 lines if you separate your selling costs. And that's something that you could look at almost every week, no problem. Jeff, can you flip back to one of those examples? Say the 5-line, which I think was actually maybe flipping forward. Yeah, let's use that one. So if you have this as a flash report that you get daily or weekly, depending on how often you want to know it, and you have some budget numbers next to this and you're tracking on budget, fantastic, right? You can go on to the next thing in your day. But if you have your cost of goods and selling costs budgeted at 67% and you see it's eking its way out more towards 77%, whoa, now you know you need to drill deeper into that one. You don't need to waste your time wading through all of the fixed expenses, which seem to be on target, right? You can focus now, drill down on those. And if you have it set up by department, as we were talking about before, now you have an even better tool to help you focus on what needs your attention and not have to worry about or be distracted by the things that don't.
So dig a little bit more into the organization by department. How does that help?
Okay, so if you go back, we had a slide about matching protein costs with protein expenses or sales, and same thing for produce. So whatever the major channels are in your business, you can see what is coming in related to that. So in this example, right, we were looking at protein sales of 143,000 and protein costs of 132. We thought we were making $11,000. Well, if I saw that, I'd want to dig deeper because I know I should be making a lot more, like 30%. So what did we find out from digging deeper into this report? Oh, we're looking at this on a cash basis. It's not accounting all the revenue that we've earned. It's not accounting for all of our costs. So we need to look at that further. If we are looking at accrual numbers and we see that it's still 8%, wow, now I need to go further and look at that. Why is it so low? Did we donate a whole lot of meat to some event that's not been accounted for properly? Did we put something on sale because the power went out and we needed to move it really quickly and we just wanted to get rid of it before it spoiled? Did we end up having to throw it out because we couldn't sell it before it spoiled because the power went out? Those are all the kinds of questions that we'd ask, and then we can figure out what do we do about it. Wow, the power's been out twice and we've lost $8,000 worth of stuff. Definitely time to buy a backup generator and make some better decisions for the business that way. And when you can do this by department, you can focus in on proteins when it's proteins that needs your attention. You don't need to worry about produce, for instance, or greens or whatever other department is doing okay at the time. You just need a quick check that says, yep, they're on target, move on to the next thing.
And I'd add to that, just like many of the other things that we've shown or talked about, this example shows gross margin as a percentage. And that's an easy way for you to understand your benchmark, what you're headed for when you see it as a percentage of sales. It's a lot harder to do with numbers because really if you say, oh, my cash versus accrual, you know, whether you're looking at the $11,000 number or the $61,000, you have to remember what you did in the same period previous year kind of thing. Mm-hmm. That's harder to remember. So, you know, the quick and dirty, if you get used to transferring your numbers into as a percent of sales, it's a lot quicker for you to look at it and figure out if something's going wrong. And eventually, you're going to know exactly what dollar amounts you're going to expect, and that's experience as a manager. Beginning as a manager, use percents.
And that also helps too as you grow. I mean, if you're rapidly growing, what was 8% on 100,000? You could do that math as 8,000. But what happens when you're 250,000? Or you can still do that math, but it just takes a little bit longer, and you have to think about it. So if you've got it prepared in the dollar and percent fashion, then it's a lot easier to compare regularly.
And it seems to me like year over year, you can understand how the efficiency of your business is changing as it, one hopes, grows. You can say that if you're under percentage, it seems like
and that's a great point about growth too, Jeff, because so many of us sacrifice margin to chase growth. And the challenge with that is growth provides a lot of risk, right? So you're working with twice as many whatevers. That may be twice as many customers, that may be twice as many products, that may be twice as many items within the same product lines. But now you've got the risk of them spoiling, you've got the risk of them getting to where they need to go, you've got an added risk of getting paid on time or getting paid at all. All of those things don't double when your business doubles. It's actually an exponential growth in risk, just like your other management headaches don't double, they quadruple, you know, when you grow in size. So that's a really good thing to think about and to compare for your business year over year. If I doubled in size with the amount of lambs that I sold, am I still making at least the same amount of margin? And I really should be after making more because I'm taking that much more risk.
That is a great point.
Thanks for reminding me.
Can you review where a truck lease expense would fall in terms of Cogs or not Cogs?
Take it, Gary.
I would, you can go back to
This is what you want to see.
It's a lease that you're going to pay whether you drive the truck for one delivery or 100 deliveries. It's an overhead cost. That's the easy way to look at it. Your variable costs are going to be the fuel you put in the tank, the labor for the driver, that sort of thing. Repairs and maintenance, again, are fixed cost and overhead cost, because you're going to have to fix the truck whether you do the 1 delivery or 100 deliveries.
And COGS is cost of goods sold. So as you can see over here, variable costs is another word for COGS. And so a lease would actually not be COGS. It's a fixed expense.
If you spend
think about it in terms of never using it.
Mm.
You know, so if something happens, the truck breaks down and you don't use it that month, you still have to pay the lease payment on it.
Or alternatively, another way to think of it would be, if you do one more delivery, do you have to pay an extra $1 or $10 for the lease? The answer is no. So it's not a variable cost. The more you sell, that lease price doesn't go up. You drive more miles, it takes more gas, but the lease price stays the same. Lease payment.
So in terms of managing your resources, it seems like for a given fixed cost, the more use you can get out of something, the better your margin's going to be. Right. So
sure,
absolutely, because you're
the definition of productivity. That you're using that asset to its fullest extent. I mean, if you can get somebody to drive that truck 24 hours a day making deliveries, that's really good. Problem is, most of the people you're delivering to are not open 24 hours a day. Nor does the driver want to be there 24 hours a day.
But you know, an issue that smaller growing hubs run into is, should I buy this truck or should I just rent it? And if you are only having 1 or 2 deliveries a week, they may be, you know, delivery cycles. But if you're only doing, then you're paying, if you buy a truck or you lease a truck rather than rent, you're paying for 7 days, even though you're only using it 2/7 of the week. So something to consider.
and a great, you know, break-even analysis. At what point does it make sense to do it? Because yes, the daily rate is much higher than the monthly payment would be. However, if you're only going to use it for a short amount of time, you know, and that comes up in any business. You know, hay is the perfect example. You know, do you really need to buy your own hay equipment to the tune of $100,000 when you're only going to use it for 3 weeks of the year, maybe 4 if you're lucky to get a 4th cutting? That's got to fit in with the priorities of all the other expenditures you'd like to make, and just where does it rank in terms of its return to the company? When you have a neighbor who does a great job making hay, and yeah, maybe he charges you 50 cents, you know, extra a bale than what it would cost you to make it, but now you have $100,000 you could do with something else.
Okay, this is someone who is considering looking at potential investors possibly getting a loan. So this is a question, if we are modeling an income statement, a profit and loss projection for the upcoming season, should we use cost of goods sold from the year prior, which is what we know, or should we project our cost of goods sold for the upcoming year? And these are just a guess, but based on the changes intended to be made.
Right. Well, I think you definitely need to forecast your cost of goods based on what you plan to have happen. Because if you plan to grow by 30% in revenue, your costs are going to increase along with that. Now, do they increase by 30%? If all else is equal, yes. But are there efficiencies to be had because you are growing 30%? Maybe, in which case your costs don't go up by quite 30%. Or maybe there's some cost to that growth. As I said before, often we chase it at a lower price, in which case our cost of goods grew 30%, but our income didn't grow 30%. So I think those things are important to consider. But if I was looking at a business plan that showed 30% growth with the same cost of goods from last year, I would be questioning that pretty closely, because if you're going to sell more tomatoes, aren't you going to have to buy more tomatoes or grow more tomatoes to make that happen? You know, so how are you going to source all of that? That's going to cost some money. Your fixed costs, on the other hand, though, last year would be a very good place to start, with a little bit for inflation, knowing that somehow my utility bill always seems to go up a little bit, even if I'm not using any more kilowatt hours. Interest might stay the same or actually go down depending on what loans I have now and if I'm making progress on them. So those are a couple examples, but I think the fixed cost with a little bit of inflation added would definitely make sense to use last year's as your base. And then this year, whatever you're projecting to happen, your cost of goods or cost of production need to have that same or a similar proportion with income as they did in previous years. And if they don't, then make sure you do a good job of explaining why. We put in this piece of equipment and it ended up reducing our labor, or it will reduce our labor costs by so many man hours or so much percentage. And that's why we're saying that there are going to be less cost of goods than there would otherwise be. But there'll be added overhead because we bought something.
And I'd point out also that this is a good advertising question for next week's webinar on cash flow, because really what, for a projection purpose, it's if you're doing your cash flow analysis budget on a spreadsheet, you can make those assumptions based on what you already have for an existing budget. You can say, add a certain percentage throughout, for fuel costs. Let's say your fuel cost is going to be lower this year than it was last year. I think that might be the case, that prices are a little lower. You can do that easily through a cash flow budget, and also you can identify tangible things in the cash flow budget. It's a little harder to do maybe to project from your income statement. Maybe that's just how I think. I like to look at the detail and see, okay, what am I spending that money on? And that kind of detail is in a cash flow analysis.
With this is my inclination, but I'm not quite sure. So this is Jeff's question. In a in a cyclical, sort of a yearly cyclical business like a food hub or a lot of agricultural businesses, does it make if I'm trying to understand the direction my business is going, does it make sense to compare the profit and loss for a quarter or even a month compared to the previous year's similar month, or does it make sense to do a full year versus the full year sort of running?
I'd start with
Go ahead.
comparison. I'd start with the shorter period comparison, because if you're comparing truly month to month or period to period, it should be about the same. It's not like the weather season or your sales season changes that much. The reason to compare to a shorter term period is that what you're doing is you're managing more closely. It's like what Aaron was saying before about you may have to look at your P&L every week during your busy season, so that you can tell when something is starting to go wrong. That's the reason I would say compare to a shorter term period and do it more often. But I interrupted.
I think it's also, well, I think it's important to know what is your goal for this. So if it's a management analysis to see what the overall trend of the business is, right, that's a more up here 30,000 foot view, and that would make sense to do year to year to year to see how we're performing. But Gary's absolutely right. If we're looking at the minutia of, okay, how are we progressing through the season, then yeah, you might want to look at it on a seasonal basis. We do that a lot in the green industry because there's a spring season for plants. Summer is very different. Fall is still very different, and Christmas is a whole other ballgame in terms of plants. Whether people are buying trees or wreaths or whatever, and that really is holiday based. It's not so much calendar based. So those things are very important to know, because the profit margins and the costs are going to be very different from season to season. But the weather and the holidays can seriously impact that. So if Easter is in March versus April, that does have a huge impact on plant sales. Mother's Day is always May, so that's good. But then the weather also, is it really warm all the way through, or does it stay really cold into May? May not make sense to compare March to March. And a lot of those guys also say that a weekend's worth of sales in March is about half an hour's worth of business in May. So you need to So think about what you're trying to accomplish from this, and then put the reasonable parameters around it, and then go there, rather than dive always into the details first.
Mm-hmm. Does accrual accounting make shorter periods better comparisons? It's because it might be less lumpy. You just happen to get a payment in July of 2015, but the payment didn't come in until August of 2016, that sort of thing. But with accrual,
so you would really need to keep account of that. So that's, again, we were talking about, using the bill pay feature or something like QuickBooks, so that you're recording the expense when it's actually incurred rather than waiting until it gets paid. And yes, if you're looking at things on an accrual basis there. And by the way, if you're entering the bills, QuickBooks or another program like that will do it for you, and then you just toggle one switch to look at a cash report versus an accrual report. But you have to do the input correctly to get that report to come out. If you're just writing the checks and only entering the checks as of that date, it'll be the same. But if you do the bills and then pay them through the bill pay feature, it will then indicate when the check was actually paid. And now you'll see a difference between cash and accrual. That's pretty darn useful.
There's another specific question about, is advertising and marketing a fixed cost, or should that go under Cogs?
Ooh, great one. Okay, so let me ask you this. The radio guy comes and says, have I got a deal for you? For $4,000, I'm going to give you this whole slew of radio time, and all you need to do is sell $4,000 worth of produce to make that pay for itself. Is that true, or is that not true? What do you think? What are we missing? What do we have to pay for before we can pay for that advertising? What in the income statement has an earlier claim to those dollars?
Yeah, I have to buy the produce to sell it.
Right. And that's going to vary with how much business we do. So the advertising or the marketing really needs to come after, and it's going to be a fixed cost, because while you think about it improving your sales, if you bought that ad in the yellow pages that nobody looks at anymore, it's still a fixed cost because the money's been spent. It's not going to have any impact on sales. And you're also not using it up as you're selling stuff. Like put the money into a website, that's the $3,000 or whatever you spent. That's not eroding as you sell more things. Whereas you're using up your stockpile of seeds or your boxes of produce or your jars of tomato sauce or whatever as you're doing more business on the other side. So by way of example, I would put advertising in the fixed cost category.
Okay. Here we're looking at the income statement here. Can you highlight again the things that you would focus your eye on most acutely? What are my most important things? What do we need to worry about here?
The bold ones.
Good. Good.
Which would be our 5-line statement. That's what we're plus adding the total selling cost. That's why they're in bold. Those are the ones that you should be expressing in terms of percentage, so you can do at a glance. You can look at it and say, oh, up, down, whatever.
Mm-hmm, mm-hmm. Good. Okay. Good.
Add to that, Jeff, if you think about it, when you wake up in the morning and you've got a cooler full of produce, you should think about selling it, right? So it's not like, and the first line that we're looking at here is total income, which is sales. So it's not like we're saying do something unreasonable. The income statement is really kind of a map to, so what are you going to do today? I'm going to wake up and I'm going to look at sales and how much did this stuff cost me, and what did it cost me to get it to my customers, and should I, what did my rent cost? All of those things are normal business things that you should be focused on. That's why they're on the income statement.
had another great example. One of my coworkers said, people always talk about the balance sheet as a snapshot, right? So it's a point in time, it's a picture. So if we have a picture at the end of 2015 and a picture at the end of 2016, the profit and loss statement is now the movie that explains how we got from the still picture at the beginning of the year to the still picture at the end of the year. Because a lot happens in that time period that isn't necessarily captured just by the changes in the balance sheet. And that's where we're going to see these three reports fit together.
And what would the cash flow statement be in that analogy?
That would probably be like the Cliff Notes of the, I didn't get that part of the story from the watching it. You have to go.
It's all the stage direction in the script.
That's good. That's good.
Oh, that was his sister?
Wait a minute, he's dead. Okay, so
that was a flashback.
He made the whole thing up. Okay, we have our questions queue is empty. Are there any other questions out there? Raise your hand or type them in. Otherwise, we will send you along your way. So I'll give you just a second to type in or. Our next webinar is Tuesday, the 14th. This is when we will start talking about the Cliff's Notes, direction notes, the cash flow statement. So I will see you all then. Thank you for your excellent questions and participation. And Aaron, Gary, thanks again for your wisdom.
Thank you, Jeff, and for organizing all this.
No, yeah,
See you next time.
Yeah, don't forget, do your post-webinar survey, and we'll see you Tuesday. All right, bye-bye.